Howdy. This week's topic is on financial risk, and I believe this is the topic that we are most familiar with, even though we don't understand always the cause and effect. So basically, what is financial risk? Well, we've all had certain times in our lives when we felt financial risk, right? But basically, the classic definition is the unexpected changes in external markets, prices, rates, and liquidity, supply, and demand. Now, let me explain that a little bit. If we expect the changes, we can plan for them. Risk is based on something that comes up that we didn't expect. Many times, financial risk is beyond our control. I think I've shared with you the story before of a company I knew in Austin, located in Austin. All the employees were Austin, but they went bankrupt shortly after 9/11 because all of their clients that did, maybe not all, but let's say 80% of their work in complicated financial derivatives calculation. The company was owned by a PhD in mathematics. All the customers' businesses were destroyed on 9/11. So this person had a financial risk in that her company depended on, and this is multiple risk, having all your eggs in one basket with your clients and everything, but it's also a financial risk because it was a cash flow risk. I used to start and own and operate a number of small businesses, and just those real estate agents say location, location, location. I always said cash flow, cash flow, cash flow. Great businesses can go out of business because of the financial risk, because they don't have the cash to keep the doors open. So it's not just looking at the shareholders are going to lose money. What I want to have you think in your mind is it's the context relates directly to supply and demand, as in, is there access to necessary cash or credit? Can you keep the doors open? All right. And we'll see how this breaks down. So we talk about market, credit, and liquidity risk. Now, again, these are the classic definitions that we're going to use. So, I want you to be thinking about this. Think of your own enterprise, how this could be impacted. We see this periodically when Congress doesn't pass a budget and the United States basically shuts down. We see this in bankruptcy sales. We see this in when the market suddenly crashes or has a downturn because of something. We see this financial risk either due to markets, due to credit, due to liquidity. It's all around us. It's what basically runs our capitalistic society, is taking risk and executing and acting on those risks. And then it's the ability of managers to handle that risk that make them more successful than others. So liquidity risk is just that. You got some short-term financial demands and you don't have the money. It's a cash flow issue. You'll see fire sales. We need to raise money, so we're going to have this hard asset and we're going to put it up for sale or do something like that. But basically it's, I don't have money. I need money. I need to make payroll. I need to pay taxes. I need to keep my factories open. I need to do whatever I do with my money that will eventually make more money for me. But right now, I don't have the basic money to keep going. So it mentions here about China's smaller banks. It's a good example. China, they withdrew more money than the bank can provide. This used to be a problem in the U.S. Now we have certain amounts of minimal amount. Now a bank might have assets, let's say of 100 million. They're not going to have 100 million sitting back, but we have regulations of a certain percentage. So a liquidity risk. There's a certain percentage of cash that they need. But the liquidity risk can be all around us. It's not just a banking risk. It's not just a government entity risk. It's a risk that pervades all of our business community. Then there's a market risk. What happens when the performance of the financial markets somehow has an effect? The Fed raises or lowers rates, so credit comes and goes. The stock market, some these other factors. So a lot of it is just what our investments are that feed that. Gas prices fall, okay? Gas prices fall. What does that mean? Well, that means it may not be profitable to keep those drilling rigs in West Texas operating because you can't operate them enough because the market's been filled with cheaper gas that they would have to compete with. So we've added this slide here about market risk on interest rates. Few of you are old enough, if any of you, that when President Jimmy Carter was president, we had the highest interest rates post-Civil War. If you wanted to mortgage a house, mortgage rates were 18%. My husband at the time and I had an investment property, and the note was going to balloon, and we basically went to a bank who lent us like half of the value of the house. Basically, as we said, we MasterCarded the house. We just paid interest on the house for a year or two until the situation changed. Well, otherwise we would have been foreclosed on. So there's all these interest rate risk. We are right now in a time of very low interest rates. That is historically an anomaly. Before I moved to Texas in 1984, the early 80s, I can remember real estate agents and bankers in where I came from, where I had lived for a few years, Dayton, Ohio, saying you will never again see single-digit interest rates on mortgages. They will always be 10% or above. Well, gosh, look at what we have now. For many, many years, we have interest rates on mortgages, very low. My interest rate on my 30-year mortgage is like 3.65%. It almost doesn't pay me to pay it off, right? Well, that's a big market risk. The interest rates, the access to capital, it all feeds in together. And then the credit risk is a possibility resulting from a borrower's failure to repay a loan or meet contractual requirements. Now, most people think, well, I don't lend money, so I don't have to worry about this. One of the biggest problems in credit risk is this. Companies don't understand that they can have a payment made that is just and valid for services or goods rendered and have that clawed back if whoever made that payment is in federal bankruptcy. My son is a corporate bankruptcy attorney in Houston. He's had several experiences of this where unsecured credit is trumped by secured credit. So companies will get paid for invoices that are valid. They provided goods and services and they get paid, and within so many days or months, if the company that paid them goes bankrupt, the federal government bankruptcy court can claw that money back. It's a great legal term, claw back. Make that company repay because it was for an unsecured debt instead of a secured debt. So when we talk about credit risk, look at this definition: to repay a loan or meet contractual obligations. Hey, but wait a minute, I had a contract with you. I provided 5 people at your company and for 3 weeks, and I was expecting so much money so I can pay those people, but it's unsecured debt. So to meet contractual obligations, if that supplier then declares bankruptcy, this is a big risk. So this is kind of an overview of financial risk. As I said, most of this are very familiar with this. We use it every day. We use it in our own personal lives. Do I buy a car now? Do I wait till the end of the year? Is there going to be credit available? Are they going to lower the interest rate as they did for me? I lost my car in Harvey, and I was very pleasantly surprised when I went to Toyota to replace it that they were offering 5 years 0% credit and significant markdowns because I was buying a year-end model. All right, so we use this in our daily lives. Thank you for staying with me. Looking forward to our Zoom sessions later.